Hi, and welcome back to Plant-Based Portfolio, where we explore all things related to investing and trading plant-based stocks. Our aim is to help you put your money where your mouth is and invest healthily in companies that align with your values, whether you live a plant-based lifestyle or not. In this video we will be diving into the Laird Superfood Q2 2021 earnings report. We will start by comparing the quarterly performance with estimates, then explore the financial statements, analyze the chart, and end with a review of leadership commentary and our final thoughts. Before we dive in, feel free to smash that like button to let YouTube know that you value this content, and subscribe and click the notification bell to make sure you catch the latest videos. Awesomeness. Let's get started. During Q2 2021, Laird Superfood, ticker symbol LSF, achieved revenue of $9.2 million, missing expectations by 9%. EPS came in at -70 cents, missing expectations by 25%. That is a huge miss. Companies can have bad quarters, but a 25% earnings miss is a huge red flag. Moving over to the earnings report, let's see what we have. Revenue at $9.2 million, an increase of 64% year over year. Not bad. Breaking down revenue by distribution channels, we see that online sales account for the majority of revenue at 63%, with direct-to-consumer up 94%. Would have figured online was direct-to-consumer, so not sure where this figure is coming from. Let's see if it is explained further somewhere else in the report. Wholesale sales contributed 35% of net sales. Gross margin was 24%, largely unchanged from a year ago. Would always like to see improving margins, particularly with gross margin, but with inflation, the cost of goods sold is probably increasing. Looking at the net loss, the EPS of -70 cents corresponds to a loss of $6.3 million, a worsening of 56%. That is pretty bad. Let's skip down to the 6-month revenue data broken out by product lines. As you know, we prefer this data to 3-month data as it adds a more comprehensive view of long-term performance. So, coffee creamers, the largest product line, grew sales about 25%, while product sales diversified away from reliance on the creamers with the addition of Harvest Snacks via the acquisition of Picky Bars. Always good to see product diversification. Okay, interesting. Shipping income. How does Laird Superfood make money by shipping? Anyway, good that returns and discounts are in line with last year's proportion of net sales. Now looking at 6-month sales by distribution channels, we see online distribution increased to 61% of sales from 59%, while wholesale decreased to 37% of sales from 41% a year ago. Would have expected the reverse, with wholesale sales outpacing online as the reopening prompted more in-person shopping. Interestingly, we see that food service sales doubled their share of revenue year over year, which may indicate that customers are returning to restaurants but prefer to buy retail products online versus in-store. Perhaps this points to the stickiness of online sales channels as being really easy and convenient. This will be a key point to keep our eye on in future reports. Okay, moving to the operating statement. 6-month data. Though gross profit grew about 18%, gross margins decreased from 31% in 2020 to 24% in 2021. Inflation is likely having an effect here, causing rising goods prices. Looking at general and administrative expenses, we see that stock-based compensation increased 520% year over year. That is a lot, but you have to incentivize workers somehow. Insurance expense increased 1,695% year over year. I wonder what they are insuring their business against. Let's see here. Sisters, Oregon. So Laird Superfood is based in Sisters, Oregon. Let's see if there is anything going on out there. Small town of 2,643 people. Any recent events? Okay. Firefighters. Okay. A lot of fires. Well, the insurance expense makes sense. Okay. Getting back on track. Product development expense increased about 325%, which is a lot, but spending on research and development is key for growth. Total sales and marketing expense increased 52% and total expenses increased 85% year over year. Net loss worsened to 133% to a loss of $11.6 million. No bueno. Management needs to find a more efficient and cost-effective way to grow. Now, let's take a look at the cash flow statement. Loss from operations was about $11 million and loss from investing activities was about $11 million, notably due to the acquisition of Picky Bars we mentioned earlier. So that means the free cash flow, or FCF, is negative at about $22 million for 6 months of operation. Without that acquisition, the FCF is close to minus $12.5 million, which is an annual burn rate of about $25 million. Next, on the balance sheet is about $75 million of total assets, $35 million of which is cash. So, at the current burn rate, the company will run out of money in 2 years. We'll definitely look for them to take on more debt or issue more shares in the next year or so, if revenue and earnings don't start to improve. Okay, let's see what the co-founder and CEO Paul Hodge Jr. has to say. Broad-based growth was a key theme from our second quarter results as we delivered solid gains across all major channels and categories. He also notes, we introduced several new innovative products during the quarter and are very pleased with the early results from the acquisition of Picky. So here he is basically saying that the highlight was the acquisition of Picky Bars. Otherwise, no clear guidance for the rest of 2021. Not very encouraging to hear from the CEO. He also later mentioned that he was stepping down without a replacement in mind. Potential red flag? Finally, let's take a look at the chart. So here we have a 1-year chart and the price has been trending down pretty steadily. That is a 47% loss over the past 12 months and about a 65% loss from peak to trough. 1-year highs were about $57 a share, and the bottom is about $20 per share with the price falling the day after earnings. The market clearly did not like these Q2 earnings results. Final thoughts. Laird Superfood missed both top and bottom line Q2 2021 expectations. Though revenue growth isn't horrible, costs seem to be the culprit here and have gotten way out of hand. At the current burn rate, the company will run out of money in the next 2 years. As mentioned earlier, it seems Laird Superfood will have to take on more debt or issue more shares to survive. Also, the CEO stepping down does not inspire confidence. The one good point seems to be the acquisition of Picky Bars. Picky Bars brought in about $1.3 million of revenue in Q2, which extrapolated is about $5 million revenue per year. The purchase price of $10.5 million means that Picky Bars was acquired for about 2.1 times current revenue, which seems like a pretty good deal. If Laird Superfood can cut costs and refine their product line to high margin products and focus on online sales, they may have a chance. In the meantime, we will carefully watch Sticky Bars revenue growth and FCF and try to avoid bag holding. Thank you so much for watching. We hope you enjoyed this video. Please remember to like, share, and comment below. Subscribe, join us in the next video, and remember to put your money where your mouth is, and invest healthily.